think it's important to have a differentiated strategy, and it helps to be first to bring certain innovations to the market. At Tradeweb, we've really, we think, been the first ones to focus on all the trades a client might want to do across both their electronic trading as well as their relationship-based trading. It's important to remember in the credit market that almost 70% of the trading is still relationship-based, meaning either voice trades, block trades, or large bilateral transactions where you're searching for liquidity on particular instruments. We think we're the first platform that looked at all of a client's workflows and provide a range of protocols across every type of trade they want to do. We think it breaks down into the electronic component of the marketplace, which is currently about 30% of overall trading in credit, and then what's still the majority of trading, which is relationship-based trading, about 70% of the market currently. The 30%'s grown pretty rapidly from probably 20%, so we do see increased electronification. So really we start there with what liquidity can we offer the clients for electronic trading. And for us, that's been partly the launch of our all-to-all trading platform just over a couple of years ago. We broadened the network fairly significantly for clients. Now they could match off against not just relationship dealers, but dealers they might not have had relationships with, as well as the rest of the buy side. And connecting up as many people as possible through the all-to-all network has really grown our ability to provide strong liquidity for what's traditionally fully electronically traded. More recently in that space, we actually integrated our streaming liquidity, which comes from our Tradeweb Direct platform, onto our all-to-all platform as well. And in aggregate, that can add up to a lot of liquidity. It's over 10 billion of streaming liquidity that's it's available on a constant basis. If a client sends an RFQ, then they can now match off against that streaming liquidity when that streaming liquidity is the best price. So in the electronic space, it's been really about bringing more and more, a broader and broader set of liquidity to bear for clients' RFQs. When you consider the relationship component of the market, which is about 70% of overall activity, we've brought a number of different technologies and protocols to bear. We started with just making more efficient traditional voice processing. And what we did there is we linked the electronic treasury hedges, which were typically done manually, into that whole voice processing workflow. We then moved on to actually be able to net numerous transactions that you might do on a relationship basis. So portfolio trading is one of our newest protocol innovations. It's in this space of relationship-based trading. These are traditionally trades that were done via phone calls and chats and really passing spreadsheets back and forth to get liquidity. What we've done now is electronified all of the difficult parts of that process, but still allowed the client to effectively do relationship-based trading in a more efficient way. And so what we find is it's a fairly new thing going on in the marketplace, but it's growing very rapidly. By some estimates, it's probably between 3% and 4% of overall market activity. But we've done over 30 billion just this year alone in portfolio trades. So we see it as something that could very quickly grow to a much larger segment of overall activity, just because we make the process more efficient. But what we found through the process of designing and rolling out the features is it's really important to get the details right. Clients really wanted to tell us exactly what their workflow was, how the portfolio workflow differed from a traditional list RFQ, or from when they're doing non-portfolio trades where they might be trying to source each bond individually. And so for us, it was a great example of where we try to listen to our clients, take their needs from both the dealer side as well as the buy side into play, and then deliver a solution that we can iterate on and keep improving as we get feedback about what we roll out. Another key aspect of portfolio trading, which I think feeds into our overall approach, is that it's really important how we integrate portfolio trading with the rest of our protocols and services. So for example, if you're a client and you buy a basket of bonds through a portfolio trade from one counterparty, you might later in the day sell a list of RFQs to a whole bunch of counterparties on our all-to-all platform. And then we can use services like netting to look at the overall risk from all of those trades and get you hedged out into the marketplace for your interest rate risk component on just the net residual risk. So what we find is as we grow the platform, we hope there's an increasing benefit to how we integrate these protocols and these services to, again, make things more efficient for clients, as well as find more liquidity, and then make their whole operational risk sort of go down and be mitigated and more efficient. So integration across client segments and across markets is one of the most powerful things we think we offer clients at Tradeweb. So when we started our corporate bond trading platform, for example, a key advantage was that we had a really strong treasury trading network. And what we've now been able to do is achieve a really high rate of electronification where we link electronic treasury hedges with the corporate bond trades that we're doing on the corporate bond platform, making the overall process a lot more efficient, particularly for US high-grade trading, which is done on a spread basis to US treasuries. So that integration was something we thought we could bring to the table to differentiate on behalf of clients and something they weren't getting in the marketplace already. But what we found is it feeds into a broader integration, not just between markets, but also between client segments. And then as we look across even a broader set of Tradeweb, we've historically had a wholesale business as well as a retail business, and there's liquidity in corporate bonds across all three of those client segments, institutional, retail, and wholesale. So one of the things we've been working on more recently is how do we bring the liquidity from those different pools together where a buy-side client doesn't have to worry about how they interact with those pools or go into multiple places to interact with the liquidity. We can bring it all into one interface for the client. So for example, now on our platform, if you're a buy-side client and you send an RFQ to our all-to-all platform, you can actually match up against liquidity from our retail platform, which might be streaming liquidity, matching off against your RFQ, your request for quote. And then back all the way to our treasury market integration, if you do a whole bunch of trades on Tradeweb across numerous protocols, you can actually net down that risk and we hedge out that risk into the treasury market for you, no matter which protocol you happen to use. So really it's about bringing together both markets as well as client segments so you can provide the best liquidity and the best cost efficiencies for your client base. What we see happening next, and what we're really focused on, is getting these innovations and all of these protocols into the marketplace on behalf of clients. And so for us, we've seen a great acceleration in how clients are using the platform over the last couple of years. And what we tend to find is earlier on, they were focused on the innovative things that only we were doing as a platform, such as voice processing and multi-dealer net spotting. So they would come on for the things that we offer them that couldn't find somewhere else and that are really easy value propositions. Why wouldn't I make my voice trading more efficient and reduce my treasury hedging costs, for example? And so an increasing set of clients are moving from voice processing and then doing more and more RFQ trading on our platform. And one thing we focused on is how do we integrate those services? So if you come on for one protocol, you can take advantage of all the protocols we offer. More recently, we see a lot of clients coming on for portfolio trading, which is one of our newest protocols. And what we tend to find is no matter what the entry point was, we talk to a client, we try to understand their workflow, we try to understand how we can partner with them. They might have a different entry point, but as they learn what we can offer them, they broaden their usage. So if they started with voice, then we see them picking up RFQ. Or if they started with portfolio trading, then we start to see them looking at RFQ as well as our streaming liquidity, for example, along with all the voice processing technology we offer. So what we've seen recently is a nice uptick as clients get more familiar with the platform. And what we're really focused on into next year is how can we bring these tools to the marketplace and accelerate their usage.